Everyone, welcome back to the Market Chat. My name is Richard Moglen. Joining us today is Don Vandenbord, who is a senior portfolio manager over at Revere Asset Management. Don, thank you so much for coming on the show and welcome.
Great to be here, Richard. When you put out the alert that you were looking for people to interview, I said you should find somebody handsome, charming, intelligent, humorous, and humble, but instead you're stuck with me. So you've got your work cut out for you.
Well, I'm looking forward to it, and you've prepared a really awesome presentation diving deep into a study that you did about bear markets. So I'm really looking forward to that, as well as just going into some examples of your trading as well and finding more about your background. So that's what I always like to start off with. So Don, can you kind of give us a sense about how you first got into the markets, first got interested in this, and also tell some interesting stories along the way if you've got any?
Sure. Went to college to be a computer programmer and graduated in 1986 and went into the IT field, started working my way up, but it wasn't long after I was into it that I realized that, I really wasn't passionate about this. I really wasn't enjoying it. It paid well. I met a bunch of great people. I had some talents that were pretty well suited to the job, but the last thing I think when you're passionate about something, you think about it 24/7 and you're always wanting to improve yourself. And at this point, I had really no passion about the markets either. And then in 1999, I was putting a pool in my house, and I went into a pool store to look at some furniture. And the guy that owned the place kept popping into the back room, and I got to know him pretty well. I was like, "What are you doing back there, Bobby?" And he said, "Man, you gotta get online and start trading these internet stocks. It's unbelievable. I'm making way more money than I am selling pool stuff." And he got my attention. And Scottsdale Securities became Scottrade. I opened a Scottrade account and put some money into it. I had some old 401ks. I rolled them over into there, and I got caught up in the internet stock craze. And of course, I confused genius with a bull market, and came home one day from work in early 2000 with a number on a piece of paper, and I showed my wife. I said, "Can you believe we're up to this in our account?" And then I tried to project it into the future for her, and boy, was that a big mistake. And we know what happened to people that had no sell discipline after the internet bubble. So lost everything that I made, and I started looking. I started saying to myself, being an analytical type guy in IT, there has to be a way to not give your money back to the market. In '98, I started doing some research on what I should do to best invest, to do with our IRAs for that year. And I read a book about index funds, and I was like, "This is great. This is the way to go. Just put it in an index fund, let it rip." Well, I saw what happened to my index funds also during 2000 to 2002, and I said, "There's no way I'm not making any progress." So I started looking for various systems, and one that really spoke to me was William O'Neill and Investors Business Daily, because they had a sell discipline. They had rules for getting in, they had rules for getting out. I also had been listening to a radio show at this time, Gary Kaltbaum and Investor's Edge, and he talked about what an O'Neill disciple he was, and the sell discipline and everything. And that's really what got me onto the process that I needed to be. In other words, knowing when to participate in the market, or at least knowing the concepts of participating and when to sell,
Right.
and take profits. But there's such a big learning curve, especially when you're doing it part-time, when you're still working full-time. But fast forward to like 2007, 2008, when I was fortunate enough to be able to have the sell strategy to get out of the way before the financial crisis took a big bite out of my portfolio. But I saw a bunch of friends and family that weren't that fortunate. And I transitioned, but one thing I was slow on was coming in 2009. I was just convinced that I was reading too many news headlines about how terrible things were, and missed the turn. So I was late getting back in 2009 after we bottomed. So knowing that I had a lot of work to do. So around this time, I started actively seeking out more in-depth knowledge, and I started attending all of the IBD level 2, level 3, level 4 master programs, going, to several places across the country, down to Miami, up to Chicago, out to California, to really dive in and to become an expert in this approach. Because during my time in IT, there were always business boom and busts, and there were always downsizings that you always had to worry about getting tapped on the shoulder.
Right.
And I got to the point after 2010 when I was like, yeah, I want to be tapped on the shoulder. I'm burned out on this job. All I was doing was in conference calls and answering emails and doing offshore reviews of code. And I had really just had enough. When you're not passionate about something, you're not enjoying it. That's not a recipe for success in what you're doing. So 2012, I finally got the tap on the shoulder, and I accepted it with a smile, and set out to, one thing I knew is I wasn't going back into IT. I didn't know what direction I was going to go in, but I really wanted to get involved with diving into managing money, not necessarily my own, but I wanted to hook up with a firm. If there was one out there, I was going to, if there wasn't one out there, I was going to start one that where you could protect the downside of people, especially when they're approaching retirement. Because I've really got some horror stories. My father-in-law was dying from melanoma during the tech bust, and one of the big wirehouses had him loaded up in tech stocks, never sold a single thing. He lost 50% of his money. And one of my coworkers had a guy from one of the big wirehouses put him in Lucent stock, and never sold and lost a bunch of their money. So this is people's life savings that they've accumulated, and it can just take one really bad cycle as you're approaching retirement to really be life changing and not for a good. So I wanted to hook up with a firm or start with a firm so that I could apply some of these rules that I learned. So after I found actually a firm here locally in Jacksonville, touch base with them. They were the problem was they were a modern portfolio shop, and they had a small set of growth accounts that they did. They gave me a chance to manage them. We just butted heads too many times. I was wanting to sell some of the things that they were buying in other portfolios because they considered them to be a good value. And my career wasn't just really not going to progress with them. So we parted company. And then on Twitter, I came across what was called Revere Asset Management at the time. And it's owned by Dan Stewart, and working for him was Tim Razor, who worked for IBD in the education department. So he knew the system up and down.
Right.
So I hooked up with those guys, and that was in late 2015. So brought some accounts over that I was managed, started working for them, and been with them ever since. And we've had a good bit of success. I mean, there's not a lot of people out there that do what we do, that say, you can participate in the markets when they're going up, but we've got the sleep at night factor that we can apply to give you the sense that you're not going to lose what you invested. In other words, you don't have to be at the mercy of the market. We've got some rules that we can apply, some risk management rules, and let us show you how to do it. And a lot of people that we talk to that are comparing us to other ones said, nobody ever talks about the downside. They only talk about how, I'm going to make on 8% a year on average. And you guys are so different, and that's how we get a lot of our clients through word of mouth, and by having that unique approach that we can offer people.
Perfect. And Don, kind of while you were learning and becoming more familiar with the system, what were some books or resources outside of those workshops that you attended that you found were really helpful and that might be helpful for any new traders watching this?
Yeah, I've got a list actually here of people that have influenced me. And one of the ways to shorten the learning curve is always to decide what you want to do, see people that are doing what you want to do, and learn from the mistakes that they made. And
Right.
very obviously William O'Neill at the top. I mean, he's the GOAT, and David Ryan is the baby goat. So I've listened to, driving in the car, listening to the cassettes from back in the day about describing, the process and the buy rules and the sell rules and CANSLIM. And without them, I wouldn't be sitting doing what we're doing as a firm at Revere, and me personally. So those guys definitely, but some other ones that along the road, along the way, Gary Kalpom, I mentioned him. He had a radio show that was local in Jacksonville, and I went to one of his workshops early. He's an O'Neill disciple, and he's a big influence, and his partner at the time, Brian Balsanic, I got to know very well. Great guy. And these were, in fact, Brian was one of the ones that said, look, if you really want to start getting serious about this, you got to go to these workshops with IBD. You got to get, at the time was Daily Graphs, now is Market Smith. You're going to have to spend money to make money in this. And really, it's, if you're wanting to make progress in something, it's no different than a tuition payment if you're going back to school, or a car payment if you want a nice car. Well, I wanted to have a nice career, so I paid for this, and that was really the real tuition that I paid was with the IBD process, and it certainly made it worth it. And Gary talked constantly about Stan Weinstein's book, his book on stage analysis, The Secrets for Profiting in Bull and Bear Markets, and that's a must read. And then all the IBD workshop staff, that was really my real education. Mike Webster, Charles Harris, Justin Nielsen, and Keir McDonough taught a level 2 class that really got me excited, and talked about being a robo investor with a follow through day. You just got to buy something. And Mike, him and Charles, a lot of research that they did relative to good things happening above the 21-day exponential moving average. That's a big part of our process here. And without some of the stuff that those guys taught, again, they're just huge. Mark Chionis is another guy, and outside of IBD, he's another O'Neill disciple. And one of the things that he taught me is you got to stick with the liquid leaders. A lot of the stocks that I was trading were just too thin. One bad day and heavy selling, and I would get shaken out of them. And sticking with the big liquids is a way to limit your volatility. Mark Minervini, absolutely. In his Think and Trade book, his second book, chapter 10, he talks about 8 keys. That is one of the best chapters that I've read in any book whatsoever. And I've read easily 30, 40 books, but that one, I read that chapter over and over again. It's just, it's got some great concepts in there. And then Ropel, if David Ryan's the baby goat, he's the little baby goat. He followed in their footsteps, and one of the most optimistic guys on the planet. You ever listen to an interview with Ropel, as you've done several with him, you just want to run through a wall. He's so uplifting and always optimistic. And then the best chat room, JT over at Ticker Monkey, and the crowd that he has over there. If anybody's looking for like-minded traders, this guy is really, he's something I wholeheartedly recommend him. And IBD Live, once they started that, because that gives you constant affirmation about what you're doing. They've always, introduced some new research every once in a while. They've got some great guests on there, again, that drive home and try to keep you out of any bad habits. And then Ric Flair, because he's the nature boy, and applying what he did to wrestling, just being really an average guy. He wasn't 6'6" and built like a Greek god, but he knew what the fans wanted, and he gave them what they wanted. And he's one of the all-time greats in wrestling. And then, of course, bacon, because it's bacon. I mean, that's a great influence. If you start your day with bacon, things are just gonna, you want to start the day good. So those are some big influences on me.
Perfect. Those are some good resources there. And going back to when you were first learning about this, what were some mistakes that you found yourself making over and over again that once you fixed those, that really was kind of a turning point in your trading? And yeah, maybe you can think of some of those as well. And because I'm sure a lot of newer traders out there watching this are probably going through that same period, making those same mistakes. So I was wondering if you have any of those.
The illiquid stocks was a big one that
Yeah.
made a big impact on me. And one of the things I learned in IT, another one, was you can't manage what you can't measure, and you've got to keep meticulous stats on how you're doing, the setups that you're doing, and the result of your trades. Because I hear a lot of people say you've got to do what's right for you. You got to stick to your system. Well, if your system has a negative expectation, you better not stick with that system, or you're going to be a long-term loser. So I'm always looking to get into stocks that are going to make twice of what the S&P would return during the same time that I'm in them. And I have a less than a 500 batting average, getting stopped out more than half the time, but my average gain is more than twice what my average loss is. So that makes up
Right.
for it, makes it a positive system. So when you know the math behind it, I don't worry about getting stopped out. It's just part of the process. So learning the stats behind it, staying liquid, and sticking to your sell rules is the most important. But one of the things that I struggled with was, it was like when I learned about selling, it was like a kid with a new toy, and I was always looking for that downside of the market so I could show how smart I was. Everybody, oh, you're getting beat in the market and I'm out of the market. And that cost me very often. I wasn't as aggressive as I needed to be when the market was in my favor. And I'll talk about that in a little bit with some of the studies that I did, and really forcing myself to be in the market regardless of the feelings that I have about the headlines or about the market at the time. You just got to follow the trend, and you've got to have the pedal down when the market is in your favor. When the wind's at your back, you got to take advantage of it. When the wind's in your face, you get the heck out of the way. I had no problem getting out of the way, but it was getting back in very often at the right time. That was something that I struggled with. And once I set these parameters based on what the market was doing, and really refined the system, that really helped a lot.
Perfect. And could you talk a little bit more about that illiquid stock mistake and kind of define a liquid and kind of what you look for now? Maybe it's a dollar volume amount, because I think that might be interesting for people who haven't heard about that before.
Yeah, let me bring this in. We at Revere, we manage $110 million, so we can't be in stocks that if we get in and everybody heads for the door, we're going to be moving the stock. So we insist right now on $100 million in daily dollar volume. So you take the average share count over the last 50 days, multiply it by the price, and that better come up to at least $100 million, or we're not going to look at it. Um, that's incredibly important. That dovetails in with the lesson I learned from my mentor about sticking with the big liquids. And a lot of stocks come along and we can't participate in them because of the size we are, but that's okay because I've got another solution for that, and we'll talk about that in a little bit. But then screening. I'm not as concerned in a bull market. You don't have to be as concerned with the earnings growth as you do with the sales growth. If the sales are there and the company's going to continue to flourish, the earnings will come.
Right.
So I'm not going to buy a biotech that has no sales, but I will buy a stock that has big sales but is still losing money, as long as it's in a bull market. If once the market starts consolidating, those stocks without earnings are the first ones that get sent to the gutter. So that's very important that you're in the right market for those. And then the most important letter in CANSLIM after the M, to me, is the M for market, is the N. It's got to have something new, something revolutionary, something that helps you in the way you work or play or live your life. And it's got to be something new. It's not a chart. The chart does not make a stock double. It's the story behind that chart that will make the stock double. Otherwise, it's just a setup with an average stock. I mean, there's been plenty of defensive setups that looked fine over the last couple of months, but what are they really going to do? I mean, is Coke or Pepsi or a stock like that, do they have something new that's going to make them double in a short period of time? They don't. You're better off
Right.
when the market winds are in your face, just staying the heck out of the way. So you got to have an N. And I really focus on the 3-month relative strength, because I want to know a lot of stocks can still have a strong relative strength if they had a big run, but they've topped. It takes time for that year-long relative strength number to catch up to what the stock's really doing. So we focus on 3-month relative strength. And gaps and inflection points are very, very key. Another point of success that we want to talk about, because you're always on the lookout for that Facebook moment, and we'll look at that chart when we get to charts. In July of 2013, was it? I think
I think so. Yeah,
Facebook,
I think so.
yeah, July of 2013, when they had that big gap up. An inflection point like that with a company is something that you really want to get on board. And then I'm going to talk about position sizing, pyramid ads, offensive and defensive selling a little bit later when we get in a little bit deeper.
Perfect. Don, do you want to dive into your presentations? You can go ahead and share your screen, and we'll get into that.
Okay, so this is kind of the 6 points that I wanted to cover. I know it dovetails with some of what you want to talk about for the interview. We already talked about, the background and finding the right approach, but um, let's take a look at. So this is a monthly chart of the S&P 500, and you can see, long term, it always trends up, and this is what the buy and hold crowd will always point to. But there's a concept of sequence of returns.
Hmm.
You don't always get that 8 to 9% every year. And, here is the big pullback, or the big crash, I should say, from when the tech bubble burst. And here's the financial crisis. Here's COVID. And this is what's going on now. We really don't know how far down this is going to go. The S&P is down 23% right now. But do we really know how long it's going to go? No. And that's why we created rules to participate in the uptrend and get out of the way when the market's going to have a downtrend. I talked about, the genius or bull market that I confused with 2000 when I started getting involved with the market. The unconscious incompetence of some of these people that manage money that, they don't know. They're salesmen. A lot of people that you deal with in a lot of these firms, they're just salesmen. At Revere, we like to say that, the salesman is done. We're the service department. We take care of your portfolio. We know the tools to plug in to know what the code means when your check engine soon light comes on. The market gives off those very same signals, and we think that risk tolerance isn't necessarily with the individual. The risk is in the market, and the big risk in the market is I'll talk about in a little bit and how to identify it. And that sequence of returns concept, when you get these bad what kind of an advisor who was trying to set goals for people had the market dropping 50% twice between 2000 and 2009? They
Right.
say stick with the long-term plan. Well, how did that plan turn out? And that's why, and I've witnessed it, in friends and family, and that's why we do what we do at Revere, and that's protecting the downside and participating in the upside. I talked about a lot of the mistakes I made in the mentors. You already asked that question. So developing the Revere process. So when I started putting together what I would do when I got into the money management field, is I coined this term growtection. You're going to grow when the market's in an uptrend. You're going to protect when the market's in a downtrend. Well, that's great. Some people don't like individual stocks, though, and then the robo advisor, the advent of the robo advisor and modern portfolio theory, just sticking it in 8 to 10 asset classes and think long term too. Well, we do that for people that are scared of stocks, but we do it with stops. So we've got the downside protection if you just want an asset allocation account also. 3 time frames. This is what's important. We do videos at Revere 5 nights a week, and we do a podcast on the weekend. And part of the learning curve was understanding, and I mentioned a little bit about this when I talked about how key it was to know what the state of the market is and how much should I be in the market. We in our videos every night, we take a look at how are the market leaders acting, and then how are the indexes relative to their short-term 21-day exponential moving average, their medium-term 50-day moving average, and their long-term 200-day moving average. As you can tell right now, everything's red. The only thing that we own right now at Revere is a 5% gold position and a 10% VTIP, which is a short-term inflation protected bond ETF. And it's strictly because of the health of the market across 3 time frames is all bearish, and market leaders are also bearish. So as the market starts to recover and gets back above these various levels, these arrows will move to neutral and then to bullish, and that dictates how much money we're going to be putting to work in the market. Are leaders acting, or is this just a dead cat bounce? Is the market bouncing but growth stocks aren't in favor?
Right.
These are all the things that we factor in when we determine how much exposure we want to have in the market. So that's the 3 time frames. And then the study that I did on on bear markets, they don't ring. Let's do this. So here's the last 13 bear markets, as if the stats, if you didn't know how bad the stats were. So going back to 1968, including the bear market that we're in right now, from top to bottom, these were how far they all corrected. The average is 32.8% down. Right now we're at 24.5%. They say that they don't ring a bell at the top and they don't ring a bell at the bottom. But they do ring a bell when you break the 200-day moving average. That's a very critical spot. And I've got some stats here that I want to share. So the study that I did on the bear markets is that it reaffirmed that the market really does not get into serious trouble until the S&P 500 breaks the 200-day moving average. And if you wanted to have a simple system, if you sold on a weekly close below 1% below the 40-week or the 200-day moving average at the end of the week, if you exited the market then, and then you re-entered once you got 1% back above the 200-day moving average. In 12 bear markets since 1968, the average drawdown at that time, 33.5%, I added the 13th one, so that number has been adjusted. So the high to the sell is 11.3%. This is important. This means for every one of these bear markets, you started with the S&P 500, an average of 11.3% above the 200-day moving average. So if you just use this rule to get out once you broke the 200-day moving average, your drop would be 11.3%. That's easy to recover from. What it's not easy to recover from is when you go down 30, 40, or 50 or more percent. So just following this 1% rule versus the 200-day moving average, on average of those 12 bear markets, you would save an additional 23% to the downside, going from your exit of 11% all the way down to the 33%. And then if you followed this re-entry rule, if you waited till you got back above the 200-day moving average, on average, you're re-entering 8.4% below where you exited. So this is just a simple system that tells you how critical the 200-day moving average is. And if you just use that as a guidepost to get out of the way, you can avoid these big losses, because once you get below the 200, that's when risk really picks up. None of these bear markets happen without a break, a weekly close below the 200-day moving average first. That's true for the Black Friday in 1987 when the market crashed, the Friday before, Black Monday, the Friday before it closed below the 200-day moving average. A lot of systems, a lot of quant systems that are used, a lot of money managers only screen if something is above or below the 200-day moving average. So if you just use that one rule, it'll keep you out of a lot of trouble. And some additional stats that I want to show relative to that. Is this. You hear a lot of these buy and hold people say, well, if you're out of the market, you could miss the best 10 days of the market, and that would destroy your returns. Well, that's nonsense, because those 10 best days, most of them happen below the 200-day moving average, and they're bookended with the 10 worst days. So since 1960, 22 of the worst 25 days, this is dated a little bit. These stats are about 3 years old. But at that time, 22 of the worst 25 and 83 of 100 in the S&P 500 occurred under the 200-day moving average. So forget about missing the 10 best days. If you're missing the worst days too, you're cushioning your account, and you don't have to worry about getting crushed. And then the overall monthly average for the S&P is a positive 0.88%, but when you're under the 200-day moving average, it's negative, a negative 2.6%. So again, this underscores the importance of the 200-day moving average. And since 1979, 88% of the combined count of best and worst days occurred when you're under the 200-day moving average. So this, this stat alone relegates this. What if you miss the 10 best days? Anybody that says that is being disingenuous, and they're just trying to sell fear of staying in the market, because Wall Street is a giant conflict of interest. They don't make money unless you stay in their funds and you look to them for advice. So We really think we found a better way at Revere by being able to not it's market timing, but that's what it's derisively called. Sometimes we call it trend following. When the trend is up, we're participating. Trend goes sideways, we're going to back off. The trend goes down, we're going to get out of the way. So that's a pretty key stat, that 200-day moving average, and it'll just keep you out of a lot of trouble.
And how do you personally apply the kind of rules that you learned through this study? Do you really focus on that 200-day moving average, or are you still using that kind of classic? What are the leaders doing as we approach that 200-day moving average? Because for the last few corrections, it's kind of been supported at the 200-day moving average for a little bit, and then kind of falls apart after that.
Yeah, we're way out of the way. We don't
No.
hold anything down to the 200-day moving average. The in most cases, we're out of something if it breaks the 50-day moving average, and we're all out of at least half if it breaks the 21-day exponential moving average. We do a combination of offensive and defensive selling. So if
Hmm.
something moves up quickly, 10, 12, 15% over a couple of days, we're going to lock some of that in and leave a runner. And if it breaks the 21-day moving average, we're going to be out of at least half of it. And then the 50-day moving average on the downside is from a worst case scenario. So the 200-day moving average, I'm really talking about what are the overall indexes doing, and
Right.
when should you really pull back from these individual buys. But for the most part, what you're going to see is this gauge that we update every night in our videos. The short term is going to start going from bullish to neutral to bearish. Medium term is going to start working its way that way. And that's going to act as a governor, and we'll be pulling back our exposure just because of what the indexes are doing relative to those moving averages across those 3 time frames. And then when leaders start to pull back also, they can correct pretty quickly. So that's why we like to do some offensive selling.
Yeah, makes sense. And you talked about sequence of returns earlier. Yeah, it's so true. And you use the example of the 2000 correction crash, as well as the 2008, and then in the most recent 2-3 years we've had the COVID crash and now this correction. So it's really true that even if there is that average expected return, you can have some terrible events that can really set you back if you don't protect yourself. And if you're able to protect yourself, then you can really participate to the upside, and that's when you can really compound your account and get those gains over time. And it's so critical to protect your downside.
Yeah, and as far as COVID goes, the buy-in holders like to say, "Well, look how fast we snap back." But my answer to that is, okay, suppose COVID had a 4% death rate instead of the very small death rate that it did. Where would the world be right now? Where would the market be right now? We don't really know, but do you think we would have rebounded that quickly to all-time highs if the death rate was that much higher? The bottom line is you really don't know. But what we do know is that it got us below the 200-day moving average. That's when risk picks up. That's when
Right.
all these bear markets accelerate, and you just got to follow that rule.
Perfect. Yeah, I think that makes perfect sense. And have you done any kind of studies in terms of, when we get so far below the 200-day moving average, there's a little bit of a mean reversion type thing there. Obviously, stuff can accelerate, but have you looked for kind of an average drawdown below that key moving average as a kind of reference point?
Yeah, that 23% that I referenced below, that's the average pain point once you break further below the 200-day moving average. So if you use that rule that you get out there, on average, you're saving yourself an additional 23% of downside on those 12, 13 bear markets that were studied. We don't know how, this is the 13th one that we're undergoing right now, so we don't know how low that's going to go, but today was certainly not a good day for the market, especially after the Fed, coming out yesterday with their 75 basis point cut, trying to give some confidence to the market that we're going to do what we can do to control inflation. And the market said, you had a short squeeze into the close that day, and today they said, yeah, we don't know that we trust that. So we're going to follow what price is doing, not what anybody's opinion is telling us to do.
Absolutely. And for everybody watching this later on, we're recording this on Thursday, the 16th. And like we said, we just had FOMC yesterday, and then obviously a very negative reaction to that today afterwards. So we'll see what happens, but we're below all the key moving averages right now, including that 200-day moving average. And Don, any kind of closing summary with regards to that study that you did that you think people should really take away from your findings?
Yeah, I've got a part two to that study, and this is
Perfect.
my number 5 here, refining the portfolio process. So let me get into a spreadsheet here.
Sure.
So what we were doing at Revere is I want you to look at 4 sample portfolios here, and this goes to this asking the right question down here. You frequently hear people that are O'Neill disciples, and they're judging the market. They're trying to decide what they want to do, and the question asked is, how much cash do you have in your portfolio? I don't think that's the right question to ask. The question to ask is, how much risk do you have in your portfolio? So take a look at the SPY here. If you just had a portfolio that was 80% in the S&P 500 and 20% in cash, your beta would be a 0.8, because the S&P 500, that's by definition has a beta of 1, and then you measure all other financial instruments against that beta. SSO is a 2 times S&P 500. It's not exactly double, because it resets every day, but if you had a 40% SSO and 60% cash, your beta still would have been 0.8. So suppose you had a portfolio made up of these 8 stocks and 20% cash. These are, in their time, good stocks. They're leading stocks, certainly could have been owned. It's not that aggressive a portfolio. Your beta for that portfolio would have been 0.78. So how much cash do you have? I got 20% cash. How much risk do you have? I got the same risk as the market. Now look down here. If you're a growth investor and you've got these 8 stocks, the beta of those, if those were your 8 positions, your risk is actually 1.27%. But that's only if you're using beta. And what happened back in February of 2021, we had the markets were holding up fine, but this is when growth stocks started to roll over, and we had a bigger drawdown than we wanted to at the time. So we did a little bit more research, and we dug in, and we added another component to measuring risk, and we call it RVAB, Revere Volatility Adjusted Beta. So what we did is we pulled out the ATR of anything that you want to hold in a portfolio, okay? And we're going to compare that ATR to the price. That normalizes it. That gives us a percentage of how much, on average, the stock moves, okay? Follow me so far?
Yep.
So compare that to the S&P 500. Right now, this is a pretty big range. The S&P is moving on average 2.79% a day. These are stats taken from MarketSmith, by the way. And this is the ATR of these 8 stocks here. So if you looked at that, again, we're saying how much cash do you have in your portfolio? Still 20%, but your risk using these stocks, if you were just using beta, it was 0.78. If you factor in ATR, you actually had a risk of 1.01. But if you're using growth stocks that move significantly faster and you applied this ATR percentage, your risk was actually 1.89. So significantly more than the market. I know O'Neill says that growth stocks will move 2 to 3 times the size of the market, and this is absolutely correct. This supports that number. But you can say that you're 80% invested. If you're in slow stocks, you can really just have the same beta as the S&P 500. If you're in growth stocks, rest assured, what happened back in what we discovered is that we thought by just using this beta, even holding high flying stocks like this, that our risk was only approximately 1 for the S&P, 1.27, but it was actually, when we added this ATR percentage, it was 1.89. So it told us that things were moving. We had more risk that we wanted to. That's why we pulled back. Things were more extended that we wanted to. That was one of the lessons that we learned, was to factor this ATR in, give us a number for what our portfolio actually is, a risk number, compare that to how leaders are acting, how the indexes are acting, and it gives us an idea of how much risk we actually have. And then we take it a step further. We have stop set for everything that's in our portfolio, and we multiply with that stop times the percentage. So we always know at all times what our balance at risk is. We call that Revere estimated balance at risk. So at any time going into the day, we can know if all of our stops got hit that day, we would lose X percentage. And when we went back and did it, that drawdown that we had, about 14%, that's where our stops were. And I don't think we appreciated exactly how much risk that we had. Back at the time, the S&P 500 had about a 1.4%. So this risk number would have been even higher. This is a very high S&P 500 ATR right now at 2.79%. And a lot of these stocks, a lot of the growth stocks, their charts are broken. So they've had much more risk back in February 2021 than they do now, when people are really shunning them and they don't move as fast. But it's important to know, to be able to quantify how much risk you have, and we call that RVAB, Revere Volatility Adjusted Beta. So it's adding ATR to the beta, using a proportion of each and coming up with a score for the overall portfolio.
And what would you recommend kind of traders kind of watching this take away from this, that you always got to be aware that those growth stocks are going to move a lot faster than the market, and you have to kind of account for that in terms of,
Yeah.
the overall risk profile? Yeah.
Yeah, you really have to take a look at the ATR of some of the things that you own. And another takeaway that we had from it is we developed something called the G6, and that's because this didn't make headlines. But let me find this other chart that I want to bring up here. This is the bear market that I'm talking about in February of 2018. Now look at these numbers; they're pretty eye-opening. The S&P 500 only corrected 5.7% at the time. The NASDAQ 100 corrected 12%. But look at these growth proxies. We developed this, we call it the G6. And what we do is we monitor these 6 growth ETFs as a way to keep our finger on the pulse of what's really happening with growth stocks. These are the tickers. IWO is the growth half of the Russell 2000. QQQJ is a mid-cap NASDAQ 100. The IBD 50, PDP, which is a Dorsey Wright Momentum ETF, ARK-K, that's Kathy Wood, and MDYG is the growth component of the mid-cap, the S&P 400 mid-cap. Look at how much these things corrected, while at the same time, the Dow down 3%, the S&P down 5.7%. Nobody was really paying attention to what was going on because the major indexes weren't really showing anything bad.
Right.
And we compare ourselves to the indexes frequently, but we didn't want to draw down this much, and we were surprised that we did compared to them. But when we really started taking a look at the components of these 6 ETFs and how they acted, this was really stealth bear number one. It wasn't 20%, but 18.7%. And, with ARK-K being down 33%, it was pretty evident in hindsight that we needed to be out of these stocks quicker than we were. So when we instituted this G6 and we monitored them closely, there were 2 other times, November, December 2021 and January, February 2022, that these same growth proxies had what you could call bear markets as well. Again, 16.5%, not quite 20, but still 2 of them were over 20. And then on average, 22.8% in January and February. And we were able to get out much quicker. Our drawdown was only 6.5% in November, December, and 6.4% in January and February. Much better compared to what the indices are. In fact, we got out quite a bit below what the indices did in January and February, and it was thanks to monitoring this G6. And we addressed this G6 and what it did every night in our videos too. And that's a big growth proxy. This composite, we keep them up on our screen all the time, so we have an idea all throughout the day how growth stocks are truly performing relative to the overall indexes.
And how are you monitoring that G6? Are you just like watching them versus their 21 EMA, or what are you kind of doing to make sure that you're aware of how they're acting, and how do you take that into account into actions that you're taking in your portfolio?
That's exactly right. We're looking at the health of them. How are they versus the moving averages, the same three moving averages that we watch on a daily basis for every individual stock and for the indexes. So let's go back here to 2021, June of 2021. Look at the relative strength on
Yeah.
this IWO. Here's where it peaked in February of 2021, and you could see right here that there's really something going on. IWO, FFTY, you're going to see the same thing. You're going to see the lagging relative strength line on these things, the six that we monitor, lagging relative strength versus the indexes. And at the same time, even the NASDAQ 100, that was holding up. Sure, it formed a cut base, but it was really holding up fine. The S&P 500 was still going, to the upside, and the Dow Jones Industrial Average just, didn't even have a blip. In fact, it, broke out there shortly after these growth stocks topped. So very important to keep an eye on these. We monitor them, the charts of them, and how they are from a relative strength perspective.
Yeah, that makes perfect sense. And what are the things as a part of your kind of weekend routine do you kind of use to stay in touch with the health and breadth of the market? Because another component to this obviously is outside of the indexes, outside of those things, you're looking at the leadership. So first of all, kind of talk about kind of what you view as market leadership, how do you identify those, and also how you monitor those charts as well.
Yeah, we keep a watch list that we update in our videos and every Friday called the 21 over 21 list. And basically it's 21 leading stocks. We want it to be across at least 10 sectors. That's another O'Neill story. He says you don't have to diversify to international or emerging markets. You can diversify across sectors. And that keeps you from buying all software stocks or all semiconductors. So it's got at least 10 sectors, and it has to be 21 stocks that are liquid and they're above their 21-day exponential moving average. So 21 over 21, and we just keep that list updated. We publish it every Friday. Things go on and off. We've got a watch list for stocks that are possible additions to it, or if they break the 21, if they're going to come off, and we update that every Friday. And that's really the main pond that we fish in when we're taking positions. It's 80% of the time going to be from something that's already in that 21 over 21 list that we just keep up to date and just keep it fresh.
Perfect. And to build that list, obviously it's got to be liquid, but what are you looking for in terms of earnings, sales growth, fund ownership estimates, all of that for a stock to basically make that list?
Yeah, it's got to be liquid. So the 100 million on a daily dollar volume, but we want the 3-month relative strength to be there, and we want to see the relative strength line participating as well. Let's take a look at a stock that broke down recently that we actually owned during and got stopped out recently, in this ON Semiconductor. One of the strongest semiconductors. You can see it got near the top of its base, and this relative strength line was what really attracted us to it, along with the good earnings and sales growth.
Right.
And you see, and it's got a reasonable PE. PEs, we don't pay attention to them in a growth bull market, but in a market like this, you have to pay attention to it, because anything with high PEs have gotten taken to behind the woodshed. So this is a typical stock that's on there. LNTH was another one that we owned and got stopped out of. And same thing, relative strength line. This is the Facebook moment that it had, gapping out of this base back in February. That's how it first got on my radar. 1100% volume on a 39% up on the day. The market was questionable, so we didn't buy it back then. Growth stocks were not acting well, but it got on the list. It stayed on the 21 over 21 list for weeks. And you can see the continued relative strength before we finally took a position in it after it bounced off the 50-day moving average here, but then got stopped out of it but here when it broke through the 21.
Perfect. So we've kind of covered market analysis, how you select these stocks to go on these lists. Now, could we kind of talk a little bit more about how you actually go about accumulating and building positions in name you're interested in, and given the conditions we've been in, you might not have some recent examples, but it'd be great to go back to a prior winner as well as a loser, and kind of talk through how you both entered and exited to complete that trade.
Yeah, let's go back to Fastly
in 2020?
again, this is the very clearly the reason to have a sell discipline.
Yeah.
So Fastly, again, it had its Facebook moment with this gap out of a big base. We bought it initially on 5.7 and then pyramid added to it. So what we do, what we like to do is our initial position is 2% of the overall portfolio. And our stop is going to be, we don't want to lose more than 0.2% of the overall assets under management on any individual position. So that means, like at the start, if we get a follow through day and we took 5 positions to start at 2%, and they each have a 0.2% stop, we get stopped out on all 5 of them, we're only going to lose 1% of the overall account balance, the overall assets under management. So that initial 2% position and a 2% and a 0.2% stop. And then if it goes up a quarter of an ATR, we want a pyramid right away. So then we'll go from a 2% position to a 4% position. If it goes up a half a ATR, we go to a 4% position to a 6% position, and we'll do that up to 8%. We capped it at 4% in the market that we were in because we're under the 200-day and the 50-day moving average on the indexes, and growth stocks weren't acting all that great. So we capped it at 4% on ON and on LNTH when we got in it, and also in Exxon and Chevron and some other things that we traded. But the initial position is 2%, but we're looking to add to double that up very quickly if the stock goes up a quarter of an ATR of whatever the ATR is on the stock.
So it doesn't really have to do with a technical price level like the high of the past 3 days breaking through that. It's more about just once you've got that initial position, pyramiding in as it increases in price.
Yeah, in this case, with Fastly, with it being in a bull market, we bought on 5.7, 5.8, 5.11, and 5.22. So we were adding on the way up. And then we exited on 6.18. Some of the first couple of buys, those were about a 77% gain. And then on 6.22. And at that point, my notes just say, it was 30% above the 80 MA. It was just too extended. And if you go forward on Fastly, it ran for a little bit, and then we got back in it a couple times when this bad break off of the top. Right here, you're 35% above the 21-day moving average. We just don't sit through that. We're taking some off. Our last stop, we got stopped out when we were extended, as I said, on 6.22, and then we bought it back in when it came back closer to the 21, but we never had any serious gains on those before we got stopped back out again. Even though it did, make higher highs, and then you saw that big gap down. So I think we ran that up a little bit, but then when it gapped down, we really didn't make any significant money on the subsequent buys. The big money was made during this initial run up. From this gap out of the base up to the 102 number.
Yeah, and that's a question I think a lot of people have about kind of progressive or selling into strength, those type of rules. So can you talk a little bit more about looking at the percentage from some of those moving averages and when you might decide to take off part of a position or even that full position as you did with Fastly?
Yeah, well, you have to. It's very different whether you're in a bull market or whether you're in a market that's grudgingly giving gains to you.
Right.
What we like to do is to compare historically when things were running, how far above its 21 or its 50-day moving average has it gotten in the past. For example, on the indexes on the S&P 500, we go to we don't add any more exposure if we get 6% above the 50-day moving average, because the S&P just really, if you get that far extended above the 50-day moving average, you just don't go any further. You're looking for a pullback. We do something similar with stocks. We want to see what the ATR is and how extended it gets above the 21. If something is 3 ATR above its 21, we're going to take some money off the table. And then if it pulls back closer to it and it's a healthy pullback on lighter volume, we're willing to put that position back on. But we want to do a combination of offensive selling and defensive selling taking some profits when things run quickly and get extended and looking to add back to them. And you know, sometimes we don't end up adding back to them, and we'll let it'll go without us. But reversion to the mean can be very brutal for
Yep.
growth stocks, as you know.
Yeah, absolutely. And can you dive a little bit deeper into your defensive sell rules? And you mentioned it previously, sell half at 21 EMA, but kind of walking through a dummy position, what would cause you to sell defensively as a stock starts breaking trend and breaking down?
Yeah, let's look at ON as an example here. When it reversed through the 21 here, we sold half. When the next day it gapped down through the 50, we sold half. So this is just a case of defensive selling. Really, we didn't make much progress on it. We were up maybe 6-7%. We're willing to let it go. It wasn't overly extended from the moving averages. But then that hard reversal is just an example of defensive sell rules. It hit us in on LNTH also. You know, this thing was trending higher, looking great, riding the ADMA up, and then all of a sudden this hard reversal day was, I think we took half off there, and then the other half off the next day when it gapped down.
Perfect. And do you have any advice for traders who are just starting to build out their sell rules in terms of developing them or looking back in history, anything like that?
Yeah, I'll go back again to that saying you can't measure what, or you can't manage what you don't measure. You've got to keep some stats on where you're entering, making sure you're not entering extended, and then you got to get your average win rate down and know when you're winning how much you're winning, and when you're losing how much you're losing, and that math will give you the confidence to make the decisions that you need to make when the time comes to do your offensive or your defensive selling.
Yeah, I think when I first started trading, the early mistake I was making, I looked back and did post analysis and found this is I was entering the stock when it was already up, a few days in a row when it was already a little bit extended. And once I refined that and kind of learned from Mark Minervini, a few other different sources about specific entries as the stock is kind of breaking out through an early pivot, that helped me out a lot. But you don't know that mistake unless you actually go back and print out the charts, label your buys and sells, and that can be pretty, you can easily find stuff that in the moment you would never realize, but only by going back and doing post analysis you can actually figure out. So
Yeah, and when you're doing that post analysis, having this what is the S&P doing line at the top is very critical, because
right.
you'll often see that corresponds to a correction in the overall market, and we know 75% of stocks are going to do what the overall market's doing. But if you're buying breakouts during a time when the market's pulling back, they're going to be failure prone. So we want to buy pullbacks to the 21 or pullbacks to the 50 when the market's pulling back. The only time to be buying breakouts is when you're in a strong uptrend. Otherwise, we want to be buying the pullback, and the overall market and how it's doing is just so critical.
Yeah, 100%. And can you talk a little bit more about, how many overall positions you'll take on at a time? Because obviously you want to balance managing the risk while also having exposure when obviously we are in a strong uptrend. Not that we're in now, but once we do get back above that 21 EMA, 50 SMA, 200 SMA on the overall indexes and many stocks.
Yeah, and this is how we solve the fact that we can't get into some of these stocks that don't have the $100 million in daily dollar volume. We use the SSO. The Revere 60/40, if the market is in a bull trend, would be we would be 25% SSO. That gives you 50%, the equivalent of 50% in the S&P 500.
Hmm.
10% cash, so that we can quickly hedge if we need to, by buying a triple inverse ETF if we need to. And then the other half of the portfolio, the 40% of the portfolio, would be maybe eight stocks that have 6 to 8% exposure in there. But it would really, and realistically, it would be varying from 4% size up to 10% size. But using 30% or 25 to 30% of SSO to get 60% exposure, that other 30% that isn't allocated, we can allocate to the growth stocks in a bull market. So we can get our exposure up. This is, in other words, the 60% is using 30% SSO or 25% SSO and 10% cash to hedge. And then the remainder of the portfolio you can allocate to growth stocks. but ideally we don't want to own more than 12 stocks. That was one of the other mistakes that we made in February of 2021, is we had too many positions, and they all go down together
Yes, they
when
do.
they top. So
Yeah. Perfect. And what causes you to start accumulating SSO? What are you looking for in terms of price and volume action to start building that position?
we're looking for where the index is, where the S&P 500 is relative to the 21-day moving average. So even when we're under the 200-day moving average, we were buying SSO here. Once we got back above the 21, we made a couple of buys here as it pulled back and bounced off the 21. We knew that this tight range was going to resolve one way or the other. Unfortunately, it resolved to the downside here on 6/9, and we just cut the SSO when we went back below the 21. But that's when we start getting back in with the SSO, because it's not as volatile, as we know, as some of these growth stocks can be. Twice as volatile as the S&P 500, certainly, and that's why we're going to take a dip in with 10% and make sure that that's working before we build our position higher.
Makes sense. And you, as a fund manager, do you incorporate any macro analysis into your techniques, or it's really all about the price action, very classic CANSLIM, looking at what the leaders are doing as well as all these indexes that we've talked about?
Yeah, we in our videos every night we do something called the tail of the tape,
Hmm.
and we're aware of what the overall headwinds for the market are. Certainly the strong US dollar and inflation and the Fed tapering and balance sheet reduction and rising interest rates in Russia, Ukraine. Those from a macro perspective are something that we're aware of, but it's not going to, if price action is going in the face of all this supposed bad news, that's telling you something also.
Right.
So ultimately, we're going to go by the price action, but we do like to see, where's sentiment, where's the put call ratio, what's the VIX doing, what's the fear and greed index doing, so that we always have a bull case and a bear case. On 5/26, we got the follow through day and we got back above the 21. So we went to our bull case. We started, dipping some toes in the water, but that failed on 6/10 when we broke below the 21. So now our bear case is in effect. And then we're going to get, we're going to tighten our stops and respect them. We always follow the news. We're watching support and index every morning on the S&P to see, if we get up to resistance, how are we going to act? If we get down to support, how are we going to act? We go over, the action on the day. We want to see what the opening 30-minute range was and where are we relative to that, what the overnight range was in the S&P futures, and are we below that or above that? Any notes. So this 20-minute video that we do 5 times a week really allows somebody to keep their finger on the pulse of what's going on in the overall market. And then we talk about what portfolio trades that we made, what sectors are strong or weak, and then key levels on the S&P, both to the upside and the downside, that we're always watching. Where's the 50-day moving average? Where's the 21-day moving average? Where's the 200-day moving average? How far below are we? You can, like this stat here, you can get too extended to the downside. 36.37, I think that was close to the low today. That's 12% below the 50-day moving average. You can't go down forever. The rubber band at some point will get stretched and you'll have a big snapback. And if you get too extended, it's rare, but occasionally we'll take a tactical long when you get too extended to the downside.
Yeah, this is great because it kind of gives you that situational awareness, that this overall summary here about what is the market doing, and what are the leading sectors, all of that. So I think that's excellent.
Yeah, one that we're attracted to right now is PDBC, which is the thing about it is, with a lot of these commodity ETFs, you get a K1 at the end of the year, and it's just a tax headache. People
Yeah.
hate getting them, especially clients. But PDBC is a non-K1 version of DBC, and it's got oil, it's got the ag commodities in it, it's got some gold in it, and I mean, this is as nice a setup as you'll see. We've owned this in the past when it was back here above the 21. I think we got stopped out on it. We owned it in here and stopped when it broke below the 21, but this is a nice setup here. And look at the relative strength in commodities. This is where money's flowing right now.
Yeah, absolutely. And Don, I also wanted to ask you about kind of any kind of daily routines you do to make sure that you're ready for every single trading day. Obviously, that summary that you just shared is probably part of it, looking back on the day. But what do you kind of do to set yourself up for success starting from, when you wake up in the morning?
Yeah, we want to know uh, where the futures are, how is the 21 over 21 list acting? That's really the big one. Where are those stocks relative to their 21? Are there any buy points for low risk entries for us? Um, where are our stops? We update that rebar estimated balance at risk with stops for all of our positions so that we know what our max downside is. And when things start, it really gives you peace of mind, because if why would I panic because one of my stocks gap down 6%? I know if I get stopped out on everything, I'm only going to lose 4.5%, and really the maximum on this is really 8%
Hmm.
is the cap that we want to have if all of our stops will get hit on the same day. So it gives you peace of mind of knowing the math behind it, knowing how far down you're going to go before you're going to exit the market. And clients definitely appreciate it too when you can tell them, our downside right now is 2.5%. If all of our stops will get taken out, I know you're worried, but um, sometimes you have to talk them off the ledge.
Yeah. So going back to the daily routine, other than knowing your stops, what else do you kind of do to make sure you're ready once that opening bell rings?
We're monitoring. I use this Fidelity Active Trader Pro. It's just I have an entire 43-inch monitor of about 300 quotes constantly flashing on me, and that's all the major ETFs, everything that's in the 21 over 21, everything that's in any sectors that are hot, and we're just constantly looking at that, letting us know what's strong, what's weak, what are the G6 doing. Is it a value versus growth day, or value versus growth day, or is it a large cap versus small cap day? These things are usually evident in the first half hour, and they very often carry through for the rest of the day. So keep my finger on the pulse, and then just constantly going through screens. I set a lot of alerts in MarketSmith, and when they fire off, that's the feedback telling me either the good or the bad. Usually I've got a bracket alert on everything that we hold, one above that would tell me something, and one below that would tell me something different. So when those alerts start going off, that's the feedback that I need to make adjustments if necessary.
Perfect. And Don, given that you've been through obviously two other pretty significant corrections, bear markets, whatever you want to call it, what kind of advice would you have for newer traders who this may be their first, longer drawn out correction where we've seen a lot of destruction in the growth stocks? Obviously, 2020 was bad, but it was so quick in the recovery that maybe people didn't quite get a sense for this. What should kind of new traders know about going through a period like this, and how should they kind of tailor their expectations and their actions during this time?
When you're under the 200-day moving average, and if you're watching our videos, I don't want to keep plugging them, but uh, if you see this should, as the banker told Homer Simpson once on The Simpsons when an alarm was going off, have you ever known a red alarm to be good? And this is not good. And you have to condition yourself to obey what you see and just sit on your hands at times. There's a time to be a hero, and there's a time to not be. And this is no time to be a hero. And sometimes you have to go through it, and you have to live it, and you have to experience the pain to know not to do it again. It's just like a child burning their hand on the stove. You'll do it once, you won't do it again because you'll learn from it. And you have to put your ego in your back pocket and obey what you see. No matter how much you want the market to go up, or you want a certain stock to behave a certain way, or you're sold that crypto is the future. Look at the charts.
Right.
You got to respect price.
Yeah, I think that's well said. And coming out of this, once we finally do get a new uptrend, a new bull market, there's going to be some amazing opportunities because we've got this big reset. Stocks will have nice long bases to move out from. What are you personally looking for to identify those potential, big winners coming out of this correction?
This line right here, relative strength. This is PDBC. This is a commodity. When in growth stocks, this won't be leading. But if we were going to get an uptrend, we knew that ON Semiconductor, because of its relative strength line and because of the nice pattern that it was forming, the odds are that this was going to act very well. I mean, this is a semiconductor, but compare it to NVIDIA.
Yeah.
NVIDIA is the past. This is not the same pattern. Cover up the name and look at the chart pattern. And then when you find a good chart pattern, does it have an N? We did a little bit of research into this, and they certainly do have an N, and that gave us some confidence, to take the position in it over the last week when it broke through this resistance here of all the moving averages. We took a shot. It didn't work out. We got stopped out. No big deal, but the relative strength line and us keeping our 21 over 21 list diverse amongst sectors is going to, we'll have the list of everything that we need to know. Because 21 over 21, we'll have 21 stocks over the 21-day moving average. When they present good entry points, we'll swing at the pitch.
Perfect. And do you have any examples going back to 2018, 2020 that kind of exemplify exactly what you're looking for in terms of that relative strength line?
Yeah, that FSLY example that I used is a good one. But let's talk about falling in love with a ticker, and something we learned back in February of 2021. Also, PayPal. We bought this at 1124.20 when it came up through here. Okay, came up through the moving averages. It was correcting. PayPal, great. Look at this beautiful run that it was on, right? Pull back to the 50-day moving average and then accelerated just like you want it to. So our entry was 201.86. We got up to 309, and it's PayPal. It's one of the top 10 holdings of the NASDAQ 100. It's one of those stocks you should be able to trust, right? No, this went from 309 to 223 in 2 weeks.
Yeah.
So relative strength here, it was showing it when we bought it. Relative weakness when it rolled over, despite the fact that it's PayPal, that it's reliable, it's a top 10. You make all the excuses that you want. The price is telling you a different story. When hedge funds have to sell, they get out of the way fast. The market moves so fast these days, and you've got to obey your stop rules. And relative strength gives you a heads up of not only what to get in, but also what to get out of.
Perfect. And could you talk a little bit more about how you use that relative strength line to identify that relative strength versus relative weakness? Because some people watching may not be super familiar with the CANSLIM methodology of using this line. So if you could go into a little bit more details about that, that would be awesome.
Sure. Let me bring up the 21 over 21 list.
Sure, that'd be great.
That we had 2 Fridays ago. We had 21 stocks on it, and last week 12 of them failed. So that really tells us everything that we needed to know about the market. But how did those stocks get on the 21 over 21 list? So they've got it. We've already discussed that they've got to have the decent fundamentals, a good somewhat of a story. Not everything on here has the N. There are stocks that are going to be on the 21 over 21 list that I'm going to have no intention of buying. For example, AT&T. That's what's acting well, and it's going to tell you, what the current state of the market is. Is that growth stocks, or is that stocks like AT&T that have a good dividend that are holding up okay?
Right.
But let's go through the ones that we ended up getting cut. So these were on the 21 over 21 list, and they got knocked off last Friday. So chemicals were acting well, CC. And again, here's the relative strength line. This is saying, how am I performing relative to the S&P 500? You can look at charts, and the chart can look good, but the relative strength line can be going down, and that tells you your stock is actually lagging.
Right.
But the relative strength line tells you what it's doing, and then we key in on this relative strength 3-month average rating. We want things that are stronger over the past 3 months. So as I go through these, you'll see a common thread. All of these had rising relative strength until it stopped. They broke. They got punted off the list. Here's LNTH. I talked about that a lot. There's the relative strength line along with price, both going higher. Delta Airlines. This really acted well back here. It came back above, looked like the relative strength was reasserting itself, but it just broke down through all of its moving averages. Western Digital, here was the relative strength prior to it, and then it gapped up on earnings, so that got us on its list, on the list. It pulled back, and it was at least keeping up with the market while it bounced off the 21-day moving average here, but then again broke down. Albemarle, here's the relative strength of it. Topped out, formed a cup, but then broke down. Oxy, oil stocks showing relative strength, but now pretty much all oil stocks have broken down over the last week. Zim, here's the relative strength line, forming a nice pattern, but it too broke down after it paid out its dividend. AMR, coal stocks, relative strength line, above the 21, but until it's not above the 21, and then break off the list. Another chemical stock, OLN, relative strength in chemicals. AMCR, it's a packaging stock. Do they have an N? They really don't. They reported good earnings. They're showing relative strength, but this is one that's on the list that I probably would have no intention of ever buying. But it's on the list because, for one thing, we want to have at least 10 sectors represented. I don't want to have 21 oil stocks on here. But what those sectors are that are leading sometimes gives you insight to the overall health of the market. We couldn't find any banks to put on except for MTB, because all banks are basically breaking down. This one was at least forming a base above the 21 before it broke down. T-Mobile showing relative strength, broke out. What happens to breakouts in a bear market? They fail. Eli Lilly showing relative strength until it broke down. And here's an example of relative strength. Even though this is pulling back, look at the relative strength it's showing. It's telling you that yes, the market's pulling back. This is pulling back less.
Right.
So this is a situation of pairing the relative strength line with the price. This may be a leader again if the market ever rights itself, because it's has decent earnings and sales numbers. And it's showing relative strength while it's pulling back. So you always want to keep that relative strength line. If there was only one indicator that I could have on a chart, that would be it.
Yeah, perfect.
McKesson, Merck, I mean, these were other things that were acting okay until they stopped acting okay. But those are drug stocks. Unless they had a new drug that's going to knock the socks off of the world, those are just defensive things where portfolio managers are parking money. And then the 9 survivors out of that 21, all of those ended up breaking down too this week. Arch Coal broke through the 21. That's coals are still holding up decently, but Chevron, along with Devon, all the energy stocks broke down this week. Enphase was looking great, broke out of this double bottom base.
Yep.
But what happens to breakouts in a bear market? They break down. In semi, we own that. It broke down. AT&T, even that broke down. And this happens a lot. You think you can park money in staples? No. Look at how Procter and Gamble fell apart a little while back. What happens to breakouts in a bear market? They fail. Even Procter and Gamble. That's a big drop there. And another one, even though it's what would seemingly be a very safe stock, Ulta broke down. Apple broke down. Zoom. This is something very, very rare that we do. It's on the list, even though it's below the 200-day moving average. But this had a fantastic reaction to its last earnings report, and it's holding up very well and forming this base. And if you look at the fundamentals, its PE is all the way down to 24. So yeah, this stock has fallen from a high of 588 all the way down here, and it's below all this overhead. But it's something I'm keeping an eye on. It seems like after its last earnings report and the fact that their product it's a verb now. So what are we doing right now, Richard? We're on a Zoom call.
Yep.
That doesn't mean that you blindly hold on to it, because if you did, you dropped from 500 all the way down to 79. Don't get hung up on the story. It's price first before fundamentals. But since its earnings report, it's at least acting pretty well and showing relative strength. In fact, its relative strength over the last 3 months is a 94. This is an example of why we focus on 3-month relative strength.
Yeah. All right, perfect, Don. Thank you so much for walking us through your process, as well as going through all those charts. To finish things off, would you have any kind of advice for newer traders out there who are maybe struggling in this environment and any advice about patience or anything like that, in terms of how to survive this type of environment, as well as how to prepare themselves for the next bull market.
Yeah, if it's something you're passionate about, don't give up. There are so many people that I've met that follow this methodology that have hit grand slams, let alone, and the methodology allows you to hit doubles or triples or home runs or grand slams. It depends on uh, how you're wired. Can you sit through corrections? Can you go for the big move, or do you want to take a lot of 15 to 18% profits and move on to the next big thing? But um, persevere, stick to it, put the work in, stick to your stops, generate stats on what you're doing, do your post-trade review to see what you're doing right, what you're doing wrong, and stay positive. I never met a successful pessimist. You can do it. I've met so many people that have done it, that were on that list of people that influenced me, and it's just I know that they did it, and I just know that following the rules, the system works. You just have to put in the screen time, and you have to be willing to take the knocks and not take big losses so that you can live to see another day.
Fantastic. Don, thank you again for your time and walk us through your process. Outside of Twitter and your YouTube channel as well, which I'll have linked below, is there anywhere else where people can reach out to you if they have any follow-up questions?
Yeah, revereasset.com. You can get on our mailing list. We'll send out our video, our nightly 20-minute market insight videos. Uh, if you're busy and you have to drive, just listening to the audio will let you keep your finger on the pulse of the market of what's going on with leading stocks, with the indexes, and with the economy, with news. We discuss it all. And revereasset.com, get on the mailing list, and you'll get the video every night.
Perfect. Yeah, I think we'll call it there. Thanks so much, everybody, for tuning in. I particularly enjoyed this one, especially going through the study that you did, Don, about the 200-day moving average. I think that's gonna interest a lot of people. So if you did enjoy, please go ahead and leave a like down below and subscribe to the channel. And we'll see you guys in future videos. Thanks.